This podcast is not legal advice and should not be relied upon as such. You should always obtain legal advice about your specific circumstances.
Good afternoon. Welcome to the latest podcast from the Hall & Wilcox Equity Capital Markets team. I'm John Hutchinson. With me today are Deborah Chu, a partner in our corporate team in Melbourne. Welcome, Deborah. And Michelle Eastwell, a partner in our corporate team in Brisbane. Welcome, Michelle.
Thank you.
Our topic today is raising capital in volatile times. So there's no secret that companies today are facing a variety of headwinds, including inflation, interest rates, supply chain issues, other economic challenges. That presents both a threat and an opportunity to companies, but either way, there's frequently the need to raise new capital quickly, and that's our focus today. So I might start maybe with you, Deborah. What flexibility exists for companies to raise capital in a challenging market? And I think we're primarily talking about secondary capital raisings. I've looked to see the stats, and the IPO market is obviously very subdued, but the secondary market is as busy as ever. So in the secondary market, what are the different types of capital raisings that you're seeing?
Well, the main two that we tend to see are placements and entitlement issues, or more colloquially, a rights issue. And a placement is exactly what that sounds like, when a company is placing securities to a party that doesn't require disclosure, like a prospectus under the Corporations Act. And so they can be sophisticated or professional investors, or significant institutions, or other exempt investors. And actually, sometimes they are shareholders, existing shareholders. They don't have to be new investors, but they do need to fall within a category of exemption. The other type of offer, the rights issue, that's one that is made pro rata to all existing security holders. And it's the type that the ASX really likes, because it's an opportunity for all shareholders to participate in a capital raising, particularly in the context of the fact that with these sorts of offers, they're usually offered at a discount to the market price. And that gives everyone the opportunity to get the benefit of that discount. So we've been seeing, and you can do the two at the same time together.
Yeah.
And what we've tended to see is that significant shareholders particularly like to participate in an entitlements issue if there's a corresponding placement that's being done, because that gives them the right to share.
Sure.
Also, related parties are, particularly directors or directors related entities, have to get shareholder approval in order to get equity in a company. But a rights issue is an exception to that. So a director or its related party can participate in a rights issue without having to get shareholder approval. So that's a real benefit of a rights issue as well.
So Deborah, I'm guessing there are timing differences in relation to each of those different ways of raising capital, which may have a bearing on which route you go down, which I guess we'll come back to. Michelle, are you seeing anything differently?
I think what Deborah has explained there is pretty consistent with what we're seeing in the market. The additional piece that's sometimes used in substitution for an entitlements issue, again, to ensure that shareholders or existing security holders get to participate on the same terms as the securities purchase plan. So that allows security holders, rather than being offered a pro rata share or an entitlement to maintain their pro rata share, it allows security holders to participate in up to $30,000 worth of securities in any 12-month period under the particular exemption or relief provided by ASIC. So that's another piece that, again, ASX quite like, because it's giving shareholders an ability to participate at least on the same terms as generally what the placement is being undertaken in conjunction with the securities purchase plan. So it's often a bit of a combination that we're seeing, a placement combined with an entitlement issue or a placement combined with a securities purchase plan. And I think as well, probably important to note that various types of securities are being offered as well, whether the existing class of ordinary security that's listed, whether it's a convertible security such as options or convertible notes. So there is a fair bit of flexibility as to the style of raising, but also the type of instrument that's being offered as part of the raising.
Excellent. Okay, we'll make a note of that as well. I'm the chairman of the company. The company needs to raise capital quickly, either because I'm in some trouble and we're running up against our banking covenants, or because we see a great opportunity to make an acquisition and we need to raise capital quickly. In terms of the timeframes involved, what's the quickest way to raise capital with certainty?
So definitely the placement is the quickest way to raise capital, and that's why it's always an option that's high on the list from any board's perspective. And the reason for that is undertaking a placement to exempt investors can be done very, very quickly, working within the constraints. And often you'll see a company go into trading halt, and within a 2-day window, the placements are secured, announced, and closed very quickly after that. There was additional relief provided during COVID to extend that trading halt period out to a 4-day window, but that's since been pared back when you're looking at a general trading halt request for a placement. But certainly that placement is the quickest way to raise a significant amount of funds. As both Deborah and I mentioned earlier, ASX do like to see some offering to security holders in conjunction with a placement. So an entitlement issue, so a rights issue, has a much longer time frame, and that's often reflective of the need for additional documentation and the need to ensure that security holders have a fair time to actually assess and accept the offer. So an entitlement issue, you're looking more so around the 4-week time frame from announcement through to close. And that can vary depending upon whether you're undertaking an accelerated or a standard time frame for your rights issue. So an accelerated rights issue can be undertaken as an accelerated renounceable or non-renounceable. And what that allows the company to do is to access the institutional funds quickly at the beginning of that rights issue or entitlement issue. So really, when you go into halt, you will release the announcements of your institutional entitlement, and you'll have access to those funds very quickly, with the balance of the entitlement issue to retail investors coming at the back end of that roughly 4-week period.
I'll note, by the way, on the timing of a rights issue and the issue I mentioned before about related party participation, because a rights issue is exempt from the requirement, where it's a pro rata rights issue, it's exempt from the requirement to get shareholder approval of the related party participating. The related party is able to participate in the rights issue without having to get shareholder approval. And if the related party is a party that would be exempt, they can participate in the accelerated part of the accelerated rights issue. So the quick part that's done right away, as opposed to the longer one that takes 4 weeks.
But I guess for certainty, I also want my entitlement offer underwritten. So I will need to have taken the potential underwriter along the journey with me, but that could also have a timing impact, I would imagine.
Yes, and on the underwriting, and again, going to the related party issue, a related party is able also to sub-underwrite a rights issue without having to get shareholder approval for the sub-underwriting. So that's another way for a related party to be able to participate without having to take the time to get the shareholders to approve it.
And Debbie, you mentioned security purchase plan, which typically don't raise a huge amount of capital, but they're very comforting to the retail shareholders who otherwise aren't really going to be able to participate in a placement and may not even be able to take up the entitlement under the entitlement offer either. Is there anything sort of new in relation to securities purchase plans?
A securities purchase plan doesn't have the same sort of rigid ASX timetable. It's a bit more relaxed and shorter. You simply need a record date before the announcement, and the securities can be issued within 5 days of the closing date for the securities purchase plan. Basically, you need to give investors a reasonable opportunity to participate, but it can be pretty quick, and quicker certainly than would be the case for a rights issue, or even another sort of issue in particular, because you don't need to have a prospectus or other formal disclosure document.
So placement, nice and quick, but there's a catch as to how much capital I can raise. Is that right?
Well, there could be, because for a placement would be subject to the listing rule 15% limitation on placement capacity, which applies to issues of equity that aren't approved by shareholders. So every listed company can issue up to 15% of its shares without having to get shareholder approval. And certain other companies can also take advantage of an additional 10% if they're not in the ASX 300 index, and if the shareholders have approved the ability to have this extra 10%. In that case, a company can have, quite frankly, up to 25% of their capacity to issue for placements or other issues of shares that shareholders haven't approved. The key thing, though, with that extra 10% is it needs to be a placement for cash, and the price, as I said before, often with these sorts of offers, you have a discount to the trading price, but for that kind of offer, the discount can't be more than 25% of the 15-day VWAP. But otherwise, it's pretty flexible, and it can be a really great way to take advantage of that additional capacity to issue shares without having to go to shareholders in a very quick way.
Michelle, and if I want to undertake a placement, the other issue, I suppose, is I'm going to need to be able to issue a cleansing notice.
That's spot on. So one of the other constraints that companies often find when they're looking to raise capital is their ability to utilize some of these exemptions. One of the key issues there is in undertaking a placement, you need to be able to issue a cleansing notice when you issue those shares so that they are freely tradable. And key there is not being suspended for more than 5 days during a rolling 12-month period. If you are suspended for more than 5 days during a rolling 12-month period, you won't be able to issue a cleansing notice that impinges on your ability to undertake a placement really quickly. Nor can you also issue a short form or a low doc rights issue offer document or undertake a share purchase plan or a securities purchase plan. So that's really key in terms of monitoring and limiting the number of days you are suspended during the course of the year, because it does create some hurdles if you come to raise capital and you have been suspended or you're close to being suspended for more than 5 trading days. If you are, you can't utilise those short form offer documents. You'll need to actually launch a 713 prospectus to facilitate the offers being made to your broader shareholder group and the on sale.
Yeah, suspension, not trading halt. So you can have as many days in halt as you want, but suspension is potentially really bad news with drastic consequence.
That's right.
So you want to raise capital quickly.
That's right. So you want to utilise your trading halts really well. Make sure that you've got all your ducks in a row and you're coming out of trading halt when you need to without having to step into suspension unless it's necessary. As soon as you start eating into those days of suspension and you're getting closer to 5 days in a 12-month period, you do.
So unless you're confident you can get out of a trading halt in 2 days, you shouldn't go into it.
Well, you want to make sure that you're prepared enough so that you can comfortably come out at the end of the 2 days, so that you don't create unnecessary days of suspension, which can really impact on your ability to quickly raise capital when you need.
Yeah. Okay.
The other thing to keep in mind with the cleansing notice is that in order to be able to issue a cleansing notice, you need to have told the market everything basically that would be in a prospectus or that an investor would want to know before investing in the securities. So what that means is if you've got a significant transaction which you haven't told the market about, but which would be disclosable if you were issuing a prospectus, or if the exceptions to the continuous disclosure provisions didn't apply because it's such a significant transaction, you would need to disclose that transaction to the market first before issuing the cleansing notice or as part of issuing the cleansing notice.
So there's no
which can be a
carve-out.
bit inconvenient to companies because
So
they don't necessarily want to disclose things
No.
right away. And
Yeah.
so something that a company always needs to think about is in connection with issuing a cleansing notice, is there anything that we would need to tell the market that we don't want to tell them right now, and that therefore would mean that we wouldn't be able to issue a cleansing notice?
So Michelle, Deborah, are you seeing anything new in terms of the type of security being offered? Obviously, normally the offers for new ordinary shares. Is there anything different that you're seeing in the market at the moment?
It's a really good question. I've been seeing a lot of interest by investors, in particular in convertible notes, which is a debt instrument where the investor is able to convert the debt into shares in the company, usually at a discount to the trading price. Sometimes upon the occurrence of some trigger event, or sometimes within particular time frames, whenever the investor wants to do it, or under other conditions. But the convertible note can be a really flexible instrument for an investor because it's debt until it's equity. And also with a convertible note, you can have it be secured or unsecured, so that the company can grant a security interest in its assets and undertaking to secure the debt, or it could be unsecured and simply a debt until it turns into equity. So it's very flexible.
I think to that, Deborah, that's actually a really interesting observation you make, because certainly we're also seeing that style of instrument being undertaken now in conjunction with entitlement issues or other issues to securities. So we talked earlier around ASX really being keen to see that companies are also offering to their existing security holders. And that's very much also what we're seeing at the moment with convertible notes being offered in conjunction with entitlement issues. And then a separate piece to that as well is the use of attaching options and offering both short and long-term attaching options to participants in the entitlement issue, but also participants in either a placement or the issue of convertible securities. So that obviously gives the company an ability to raise additional funds down the track on exercise of those options, but also gives investors a potential upside with what they're subscribing for now if there's an increase in the market price over time.
The tricky thing about the attaching options, though, is if you're doing it in a rights offer, the exemption from the prospectus requirement under the Corporations Act will apply to a listed company's shares, but not to unlisted securities like attaching options. So you'd have to do a prospectus of some kind for the attaching options if you were doing a rights issue, but it can be a simple prospectus under 713 as opposed to a big production. But still, it is a requirement. You need to go through that prospectus process.
But it's all to do with
the attaching options.
All to do with creating a security that hopefully your investor base or your new investor base will find attractive. So it's another little allure to the investor that they have a right up to the presumably the issue price, the offer price, to participate in the future in the company, all things going well.
That's right. And I think what we're just generally saying is more flexibility in the style of raisings and the style of securities being offered. And that really goes to, as Deborah said, really knowing who your investor base is or who you're looking to have invest, working with your advisors really well in terms of identifying what the type of security is that will be of value to the investors that you are going out to, and then really understanding what the role and processes are in terms of delivering that efficiently from a timing and a cost perspective.
So if there's one thing from each of you, if there's one thing, note of counsel, one word of counsel you give to your clients in order to preserve their ability to raise capital as quickly as possible, which is one thing you'd say to them, what would it be? Michelle, start with you.
Mine is definitely to minimize suspension. You absolutely want to maximize your ability to utilize these short form disclosure documents and cleansing notices so you can quickly and efficiently raise capital without having to go to either a long form disclosure document or having any sort of delay on settlement of the issue of securities.
Yeah. Deborah?
I think the hardest thing about a placement is not the process, but quite frankly, is actually getting the investors in. And so in thinking about needing to raise funds, companies need to think about who are the most likely suspects who will want to put in additional capital.
Yeah.
So it may be existing shareholders, it may be significant shareholders who have a long-term commitment to the company. You may want to get an underwriter in to find new investors, but that's actually the hard part, the finding of the investors who have sufficient funds. And then the process just follows from once you find them.
Yeah, no, that's great. Thank you both. And thanks everyone for listening today. As always, please get in touch with us if you have any questions. You can find our details on our website, which is hornandwilcox.com.au, or connect with us on LinkedIn. If you enjoyed today's episode, then please rate, review, or follow our podcast wherever you get your podcasts. That's all for now. Thank you very much.